Over 1 million direct creditors are expected to suffer as a result of FTX's downfall. But the cumulative impact from yet another crypto disaster raises the threat of something far more dangerous: financial contagion. The cumulative impact conjures up images of the global financial crisis of 2008 through 2009. Because FTX was such an important part of the crypto economy, it is feared that limiting the repercussions would be impossible. The collapse of FTX has the potential to spread contagion throughout the economy. But how did we get here? Samuel Bankman-Fried founded FTX in 2019. The exchange expanded gradually through the beginning of 2021, but as the company started courting the general public through partnerships with sports and celebrities, its profile and trade volume increased significantly. In a few months, FTX had signed sponsorship agreements with the esports team SoloMid for 10 years for a $210 million deal, and the Miami Heat's arena for 19 years for a $135 million deal. Star athletes jumped in, starring in FTX commercials and promoting cryptocurrency to an expanding audience. These athletes included Naomi Osaka, Steph Curry, and Tom Brady. This year's Super Bowl commercial, which starred comedian Larry David, further added to the company's campaign. The company raised enormous amounts of money from investors along the road, including a $1 billion Series B in July 2021, another $421 million in October 2021, and an additional $400 million this past January. Fundraising for FTX US, a separate exchange serving the United States, is not included. At the time of its most recent raise in January, FTX's valuation was $32 billion. Bankman-Fried, the son of Stanford University professors, was notorious for playing the video game League of Legends during investor meetings, and he received investments from Silicon Valley's top echelons. Sequoia Capital, which has invested in companies such as Apple, Cisco, Google, Airbnb, and YouTube over the years, described their encounter with Bankman-Fried as talking to the world's first trillionaire. Following a Zoom meeting in 2021, several Sequoia partners grew interested in Bankman-Fried. Sequoia opted to invest in the startup after numerous additional discussions. "I don't know how I know, I just do. SBF is a winner," said Adam Fisher, a business journalist who covered Bankman-Fried for the firm, using the FTX CEO's popular online acronym. The piece, which was published in late September, has now been deleted from Sequoia's website. Sequoia has wiped out its $213 million in investments. A pension fund in Ontario, Canada, has also written down its investment to zero. The Ontario's Teachers' Pension Fund stated clearly, "Naturally, not all investments in this early-stage asset class perform to expectations." Some may have seen SBF's casual demeanor as a warning sign at that time. Bankman-Fried, who had a net worth of billions, justified his bailouts of Voyager and BlockFi earlier this year, totaling $750 million, as part of his responsibility as a crypto executive. Just until last month, Bankman-Fried was seen as the industry's white knight. Whenever the crypto sector faced a crisis, Bankman-Fried was the first to arrive at a solution. When online trading platform Robinhood was in financial trouble earlier this year as a result of the drop in stock and cryptocurrency values, Bankman-Fried stepped in to purchase a share in the firm as a show of support. When Bankman-Fried purchased the assets of insolvent crypto firm Voyager Digital for $1.4 billion in September, it provided relief to Voyager account holders, whose funds had been frozen since the company's bankruptcy. That rescue is now in jeopardy. The downfall of FTX began when the cryptocurrency news source CoinDesk published an article based on a leaked Alameda Research balance sheet. According to the report, the link between FTX and Alameda Research was deeper and more entangled than previously recognized, with FTX lending large amounts of its own token FTT to Alameda to help build up capital. It triggered a wave of withdrawals from FTX, resulting in a classic bank run. Following the publication of the news, Binance CEO Changpeng Zhao announced on Twitter that the company is liquidating all of its FTT assets, which were acquired by the exchange as part of its withdrawal from FTX equity last year. In Binance, US dollars and FTT, Binance received around $2.1 billion in cash equivalents. Zhao's tweet caught people's attention more than the liquidations because of the way it was written. They don't support individuals, he claimed, who lobby behind the backs of other industry players. FTX's native token, FTT, was heavily sold as a result of Zhao's snitching on Sam Bankman-Fried and his lobbying activities against the decentralized finance, or DeFi, sector, which caused a panic in the market. The following day, Bankman-Fried showed up to make sure everything was okay with the exchange and that his rival was spreading false information. That didn't help Bankman's situation either, as the token's bleeding continued and its price dropped below $20, putting pressure on FTX. Just one day after FTX assured the cryptocurrency community that everything was all right and that it had the resources to support customers' assets, Bankman-Fried revealed that FTX was experiencing a severe liquidity issue and that it was preparing to sell its global exchange to Binance. After about 48 hours, Binance said it had withdrawn from the deal after reviewing FTX's internal books and realizing that the matter was too far gone for it to be of use. According to a different report, Bankman-Fried sought $8 billion in emergency cash to cover consumer withdrawals, which suggests that user funds were also mishandled. After the recent decline, the $8 billion shortfall is about 20% of Binance's market cap. Thus, it is obvious from the numbers why Binance opted to back out of the deal. According to Mike McGlone, senior macro analyst at Bloomberg, the effects of the disastrous FTX fall would be felt well beyond the crypto markets, as they will exacerbate negative swings in stocks and commodity markets. Bitcoin has been one of the leading indicators on the way up, and it's a leading indicator on the way down. And it's just broken down, so expect most dominoes to fall, McGlone explained in a recent interview with Cointelegraph. McGlone anticipates that conventional stocks will continue to slump as the Federal Reserve raises interest rates in a bid to control inflation. The FTX problem, according to the expert, will also exacerbate the decrease in commodity prices as the global economy enters a time of recession. According to McGlone, the FTX stock would certainly drive Bitcoin prices to new lows. I'm afraid Bitcoin might head to the $10,000 to $12,000 area, he predicts. Analysts observe that after a turbulent few months, a lot of dangerous activity has already been pushed out of the system. However, more agony may ensue when fearful investors withdraw assets from cryptocurrency. In this environment, the crypto winter is likely to worsen, especially if concerns about the broader economic background continue to diminish interests in riskier assets. In the short term, this is going to be really bad for the crypto industry, said Jog of Say Labs. But he doesn't believe it will end things and hopes it will increase interest in his startup, which focuses on establishing more transparent, decentralized crypto exchanges. The FTX crash is predicted to drive institutional investors away from the crypto industry, just as they were becoming more interested in it. While some individuals will continue to work on exciting ideas, restoring trust in the sector's promise might take years. It's almost guaranteed to inspire authorities to tighten the clamps, rising expenses for crypto companies that will make it through the purge. It reinforces the view that any sort of financial enterprise needs extensive regulation, said James Malcolm, head of foreign exchange strategy and crypto research at UBS. Probably by 2024, the whole world will look much more coherent and watertight. On CNBC Thursday, the U.S. Securities and Exchange Commission's Gary Gensler stated that while the crypto market is regulated, investors need better protection. According to the Wall Street Journal, the SEC and the U.S. Justice Department are looking into FTX. Binance's Zhao stated at a conference in Indonesia that the 2008 financial crisis is probably an accurate analogy for what is happening. We've been set back a few years, he said. Regulators rightfully will scrutinize this industry much, much harder, which is probably a good thing, to be honest. While investors and authorities are still assessing the repercussions of this fall, the impact on anyone who does not directly own cryptocurrency will most likely be negligible. True, many bigger investment funds, such as BlackRock and the Ontario Teachers' Pension, held FTX investments, but the estimated $95 million lost by the Ontario Teachers' Pension Fund due to FTX's demise is just 0.05% of the fund's total investments. Most people should avoid investing in uncontrolled markets unless they understand the risks. It's possible to lose everything in high-risk investments like crypto, as FTX investors are discovering the hard way.